Welcome. It's good to see you again.
Good to see you.
I want to start with Dimon. Economy is good now. Yeah, there's a lot of uncertainty. He did talk about inflation taking a while to come down, and he was asked by Jim whether that meant higher for longer. He said, yeah. Still said, though, chance for a soft landing. What do you make of what Mr. Dimon has said?
Well, I think this reflects what we're seeing within the data today, which is that we're not falling off a cliff. We're not seeing this imminent slowdown, imminent recession, meaning that a recession in the first half does seem off the table. But that scary stuff in the future may mean that we could look to late 23 or even into 24 to see an actual slowdown.
What about this idea of higher for longer? Because you make the case that the market hasn't priced that in, and it's a scenario that he talked about last week or a couple of weeks ago, and he brought up again today.
Yeah, I think it's really important. The bond market is starting to price in this higher for longer. You've seen those rate cuts that were priced into the back half of next year get priced out or start to get priced out. But the reality is that the equity market is still trading at valuations as if the Fed's going to step in and save the day.
So you still think that the stock market hasn't faced reality to where we are?
No, it's not consistent with where interest rates are. The Nasdaq's trading at 26 times earnings. That's above the pre-pandemic peak and 44% above where we were trading the last time real yields were this high. Now, we don't think we have to get rid of all of that valuation premium, but this is still a very rich market, very full valuations based on the Fed guidance.
So what does that mean then for where we go from here? I mean, there are some people who are saying, well, we may revisit the October lows. We seem far from that, though. Like 15% from those levels. What do you think?
Well, I think the first step is to acknowledge that we found a valuation floor last year at 15.5 times. That may be where we see an ultimate floor for valuations, meaning we don't have to go into those dire 10, 12 times earnings scenarios. And then it's the question of what do earnings do? And if growth comes in better, maybe that saves us. That gives us a little bit of boost where we're not seeing earnings fall off a cliff. But we note that there's still a lot of risk around the margin line. It's not as much about revenues, it's about the risk of margin compression.
Yeah, but what happens if earnings don't become as bad as people think because of, as Jamie Dimon still says, the economy's good? It's like a tale of two economies or two, narratives that are out there. I mean, the economy's good, the job market's strong, consumers are spending. That seems to be the reality of where we are right now.
And here's the push-pull tug-of-war, which is that if earnings are better, that means that growth is better and inflation's better, which means the Fed's staying tight, the Fed's not cutting, which means that you can't get that big multiple upside. So we could be in a scenario where we have multiple compression. Some of that's offset by better earnings, and that's where we get into this tug-of-war scenario where we're in this sideways chop.
Why can't we have growth being good and strong and inflation coming down? You paint it as it has to be both. Like, if growth is good, that automatically means that inflation is going to be stronger than we think, and then the Fed's going to have to do more, or at the very least not cut.
I think that's the trillion-dollar question, which is how much of the inflation episode that we have was caused by stronger demand versus just supply chain issues within the economy related to the pandemic. Our view is that you already saw all the disinflation from the durable goods side of the economy related to the pandemic. So the inflation we're seeing today is a function of strong demand, tight labor market, and a lot of liquidity, which would say strong growth means inflation stays higher and thus Fed tighter.
How many hikes do you see from here forward? 3, 2, 3? What's your number?
So right now our base case is that we expect a hike in March. We think 50-50 chance right now on whether it's 25 or 50 basis points. That's dependent really on that March or February CPI data that we get on March 14th. And then we think a hike in June is very likely if we continue to see data not fall off a cliff.
Fed funds is pretty much there, though, right? Bullard, I mean, you saw the market's reaction yesterday to Bullard, who said 5.375 makes sense to him. That implies 3 more 25 basis point hikes. The market didn't fall out of bed on that.
No, and I think that we are seeing the bond market, like I said, really come to this reality, but we haven't seen the correction within equity valuations. Does it have to happen? Maybe not, but what it does is it creates a really high bar that if you don't get good news on the inflation front, if you don't get good news on the earnings front, when you're trading at high valuations, there's not a lot of margin for error.
What do you make of what Nvidia delivered and what it says about the tech trade, even though you mentioned a few moments ago the valuation valuation or with the multiple that the NASDAQ is currently trading at?
Yeah, I think that what we're seeing is this very big divergence between tech names that pulled forward a lot of earnings during the pandemic, that are seeing a very rapid deceleration in their earnings, versus tech names that are starting to see a reacceleration in some of this exposure to an improving economy or specific kinds of niche growth stories. And that's exactly what Nvidia was today.
Would you fade the tech move from the beginning of the year? Is that a sell the rally move for you?
Well, we think that we do have that very high valuation that is a key headwind. And if the Fed stays higher and tighter for longer, in bulk, yes, we would want to fade the tech move. We're remaining neutral tech. We didn't chase the rally higher, but we might take a little bit of money off the table in the event that we do see valuations too high.